Hey, what's up, everybody? Tim Albrecht here, and welcome to this week's episode of the Ask a YFP CFP segment of the Your Financial Pharmacist Podcast, where we feature questions from you, the YFP community, to be answered by one of YFP Planning's fee-only certified financial planners. Before we jump into today's question, I want to give a shout out to YFP Planning's incredible team that makes this segment possible. YFP Planning offers fee-only comprehensive financial planning services that are customized to the pharmacy professional. So whether you want to optimize your investing plan, pay off student loans, or simply build a solid financial plan, YFP Planning will help get your income working for you rather than the other way around. You can learn more by visiting yfpplanning.com. Again, that's yfpplanning.com. Okay, this week's question comes from Brian in Buffalo, New York.
Hi, Tim and Tim. This is Brian from Buffalo with a question about an HSA account. I understand and have heard from your podcast a number of the benefits of utilizing an HSA account, including their triple tax advantage. I have about $15,000 in an HSA from a previous employer. Within this HSA account, I can invest and even purchase individual shares with no commission and minimal fees. I've been thinking about using some of this account as some play money, considering the fact that I've maxed out on yearly contributions for my other retirement accounts, and I have a separate HSA with my new employer. I'm just unsure if there's any tax when it comes to capital gains and any implications on long-term versus short-term sale, or taxes on dividends or other tax concerns I should be aware of regarding this type of account. Thanks for all your help.
Thank you, Brian, for submitting your question to be featured on this week's Ask a YFP CFP segment of the Your Financial Pharmacist Podcast. Tim Baker, what are your thoughts?
Yeah, I think with this question, Tim, I'm a little unclear. I think we have to make some assumptions, but I think it's fine. I think it's a good point to kind of talk through more things about the HSA and kind of what, Brian is getting here. So we can talk about multiple scenarios here. So when he says, what capital gains tax is there and what other tax implications should I be aware of? I think that, if we're talking about potentially moving money out of the HSA or what that looks like, one of the big benefits, as he mentioned, is that the HSA has a triple tax advantage or triple tax benefit, which means that you get the deduction when you put money into the HSA. That money grows tax-free, so there's no capital gains, dividends, interest on any of the the investment activity inside of the HSA, and then it gets distributed tax-free if it's used for a qualified medical expense or once you reach a certain age 60. So like that is important. So to answer the question of like if the money is inside of the HSA, there are no capital gains. You're not paying long-term or short-term. So that's just one thing to answer. I think the second part of this is, if we decide for whatever old, new HSA, if we decide that we were going to take money out, i.e. for the purpose of play money, that would not be considered a qualified medical expense. That would be a non-qualified medical expense. So this is a good point to really outline, well, what's the penalty there? So HSAs, the distributions are exempt from income tax and taxes if it's used to pay for qualified medical expenses that were incurred after the HSA was established. So that's the critical time piece. However, if any portion of the distribution is not used for a qualified medical expense, that portion is taxable as income and subject to a 20%, not 10%, a 20% penalty, right, which is, again, different than what you typically see. So here's an example. If you were to take $5,000 out of an HSA, that was not for, that was for to buy a car. That $5,000, 20%, $1,000 right off the top. And then that $5,000 would also be taxed. So if you're in a 24% tax bracket, that's another $1,200. So that's $2,200 out of that $5,000. That's basically evaporated. Yeah. So in a 401k, it's not $1,000 penalty. It's a $500 penalty, 10% versus 20%. So that's just important to know. So I think they compound that penalty just because of the triple tax benefit, which in the other accounts is a double tax benefit. So I think, Brian, just to kind of back up, if the dollars are play money inside of the HSA, no concern or worries in terms of long-term or short-term capital gains, dividends. You won't see any of those 1099s that come for like a brokerage account or like a high yield savings account or anything like that. But if you're using that, that play money to get it out of the HSA and into the brokerage accounts, which I don't think that you're talking about, then you would get that 20% penalty. And then any of those proceeds, when you do invest it into a brokerage account, would then be subject to, the cap gains and dividend tax, income taxes, that type of thing. So I think it's really important to unpack that because we talk about the benefit of the HSA, but when those dollars are in that account, Tim, just like a 401k, it's a pretty hefty barrier to step over 10%, and the HSA even more so 20%. So you really have to make sure that those monies are used for qualified medical expenses, or you just try to cash flow that, or do whatever you can just to prevent yourself from paying that, and then the taxes on top of it. So I think, again, we're making some assumptions here in terms of, the question that Brian's asking, but I think it allows us to kind of talk through some of the ancillary things that are related to brokerage accounts, HSAs and the like.
Yeah, Tim, when I saw Brian and a question come in from Buffalo, New York, I knew it was going to be a great one. Go Bills. I think that the reason I say that, though, is exactly what you mentioned, is that we talk a lot about the HSA and the triple tax benefits and, how to optimize it and why it's low hanging fruit. But really, this gets into some more of the weeds about, really thinking, again, taking a step back and thinking about how this fits in with the rest of the plan. And if someone is thinking about there's a need to withdraw those monies versus really letting them sit in there for medical expenses or letting them ride long term, then that might change the strategy and how you're thinking about the HSA. And I think you're right. I think the question here, Brian, and you can let us know if we're wrong, is really getting at, the investment opportunities within the HSA, which is a different, scenario versus if you're actually were to pull those dollars outside of the HSA and obviously incur that penalty, as Tim mentioned. But then also, if you go turn around and invest those monies elsewhere in a brokerage account, you're going to have other capital gains to think about in the future. So tax, right, Tim? It really just transcends, so many of these issues that we think about in the financial plan.
Yep.
Great stuff, Brian. And if folks are looking for more of a primer on HSAs, we've covered it a few times, but I'd point you to episode 165. We'll link to that in the show notes. And that episode was the power of a health savings account. Thanks again for listening to this week's episode of the Ask a YFP CFP segment of the Your Financial Pharmacist podcast. If we feature your question on the show, we'll send you a super comfy YFP t-shirt. You can submit your question by sending an email to info@yourfinancialpharmacist.com, or you can record your question by visiting yourfinancialpharmacist.com/ask-YFP. If you don't feel comfortable sharing your name on the show, you can send or record your question anonymously. As we conclude this week's Ask a YFP CFP episode, an important reminder that the content in this podcast is provided to you for your informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with a financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and may not be accurate at the time you listen to it on this show. Opinions and analyses expressed herein are solely those of Your Financial Pharmacist, unless otherwise noted, and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer. Thank you for your support of the podcast and have a great rest of your week.